Hey guys, welcome back to another video, and today I wanted to talk about some stocks that I'm investing in and kind of run through the portfolio. We're midway through February about, and also kind of just talk about what the power of compound growth and making the right investments, I guess you could say. That's everyone's goal. But yeah, so I just wanted to kind of go through that and be sure to like, subscribe, and also be sure to comment down below what stocks you want to see me cover, check out, talk about in the videos. I'm open to anything, so yeah, just let me know. And without further ado, let's get into the video. So as you can see, today was a good day in the portfolio. It actually started off not so amazing. Market open and I was up, but then quickly went actually lost money on the day, down $36. But we ended up around up right now $157 after hours. So yeah, I mean, this is kind of late to be making a video about a play tomorrow, so I kind of just wanted to talk about the overall portfolio. So yeah, I mean, I just want to go through right here. We have a lot of our portfolios in Amazon. These are our top holdings: are Amazon, Elf, and AMD. Amazon, my consensus. I'll just give you a brief one for my top holdings. For this stock, I mean, Amazon's one of the biggest companies in the world. I think that they're at an attractive valuation right now compared to companies like Nvidia, or I think Microsoft's getting there. But companies like Meta, Apple, Nvidia are all amazing companies, just like Amazon. But I think Amazon is a better valuation right now for what it could possibly do in the future. I think the ceiling is a lot higher for this company. So that's the reason that I'm invested in Amazon. Elf, this is one that is a falling knife. I've talked about it recently in my videos, but I mean, we're up 4% today. Well, we were down 32, now only down 18, so it was a pretty nice recovery. We can see I was down like 40%. I definitely did a dollar cost average, but I was down almost 40%. Now I'm down not even 2%, so this is a great thing for me. I'm happy that it's bouncing back so fast. Very excited to see that. And yeah, with this stock, I'm invested in Elf. The consensus for this one is that they're one of the biggest companies, or one of the biggest makeup companies in the space. Their market share is insane. Everything that they're doing with their business and expanding worldwide, and they have the social media part of their business. They're getting into skincare. They have makeup. It's a big customer base. It's only growing. And the fact that they're expanding that nationally very rapidly, gaining market share in other parts of the world, I really like what they're doing. They're a great company that's focusing. Their growth rates did slow down, but they're still amazing, and I think they're going to get back to those growth rates eventually. So that's kind of what my consensus is for that stock. And AMD, kind of the same thing. They were an amazing company. This past 5 years, they're up. Past year, they've been, people like to call them advanced money destroyer. Not a very nice name, but this is a stock that if you've been invested in it in the past year, you're not happy at all. The market's up around 20%, AMD's down 35%, so that's about a 55% swing. Not a fun one to be a part of. Down a little bit in this investment. I'm still building my position, almost at about 38 shares here at an average cost of $116.71. This is a company that I mean, obviously they've been a falling knife, so we're trying to catch that. And this company is too low. It's too cheaply valued in relation to what this company has to offer, in my opinion. So this is a very attractive price, one that I'm definitely willing to pay for a company like this, and I'm very happy to. So yeah, we'll see how this one shakes out over time, but this is one that I'm very excited to own for the price I own it. And I think their growth rates are also going to speed up with their parts of business. And with I don't think Nvidia is going to be the top dog that they are right now forever. So I think AMD is definitely going to be able to capitalize on that when Nvidia does kind of fall a little bit eventually. I mean, all good things can't last forever, but they definitely are doing good right now. I can't lie. But yeah. So that's basically the top 3 holdings. And then I wanted to go over to this investment calculator. And so let's do it in my situation right now. We're at around $15,000. I'm 19, so let's say I want to retire when I'm 50. Okay, so we'll say 31 years. And then let's say that we get the market average of 10% a year, and I'm probably going to start investing pretty soon here, around $2,000 a month. So we'll just say that. Could have a $5 million portfolio about. in 31 years. So, I mean, that's the power of compound interest. You can see I only put in 744,000, got back over 4 million, and compound interest is also a snowball effect. So, let's see the difference. In 10 years, I'd invested 240,000 and I only made back 186,000. That's not amazing. It's good, but it's not amazing. And then we did 31, that was our base case. But if we go to 50, you can see we have 30 million. So we added 19 years. First time. So we're going from 10 million. Let's see that one again. 10 million, we have 400,000. Let's add 20 years. 30. Okay, we 10x'd it. That's nice. But we're still at only 4 million. 50. We're at 31 million. It's growing a lot faster. And then if we, 10, and then we add 20 years to that, I mean, hopefully I'm still in the market at this point, but I mean, we're at 211 million. Then we're up there with some pretty big dogs. But yeah, I mean, you can see how powerful compound interest is, and that's kind of what I wanted to highlight, is that we're not going for the market 10% as stock pickers. Like me, myself, and a couple other people I know, we're picking stocks because we love the company and we're assuming they'll beat the market. I mean, if we wanted to make the market returns, we just invest in the market. So let's see the same base case at 20%. I think this is around price you can expect if you're picking the right stocks. We could see we're doubled after 10 years of what we got the first time. After 30 years, a lot more than 4 million right there. And then after 50 years, yeah, we're in the billions. So we can see, I mean, making 20% a year annually is very Warren Buffett-esque. So yeah, I mean, that's something that you have to be very great to do, but I don't think it's impossible. Just investing in the right company and getting in at the right time. For a lot of these companies, you can make much over 20% for years on end. It's hard to get in a company that's compounding at 20% steadily for 50 years. I'm not sure if there's any company that's ever done this or has been doing this. But there are companies that compound by higher percentages for shorter amount of years or lower percentages for longer years. So yeah, you kind of got to find your groove in the stock market and which stocks you want to invest in to do this for you. But if you can get a higher return rate than the market, then you can see right here how much faster you can build wealth. This also comes with a lot more risk. As fast as you can make more wealth, you can lose more wealth. So this is definitely a risk factor that comes into play when you're investing in the stock market. But there's also some great ETFs that I hold in my Roth, actually. SCHG, this is a great one. They have actually returned in the past 10 years an average of 17% a year since 2009. And then also just since 2009, they've returned an average of 16% a year, which is great. This is why I love this ETF. They're also a Schwab ETF, which I trust a lot, a great company. And yeah, this is one that I suggest buying if you want a ETF that's going to outperform the market. I mean, in the long run, in my opinion, this is one that I'm putting in my Roth IRA, and this is one that I believe in long term. They actually just take the biggest companies in the world and they put them into their ETF, so that's why they've been so successful, and they just shuffle the biggest companies in and out and the most successful. So that's why I think that's a much better strategy than what the S&P does. Definitely is a little more volatile, but there's also the holding fee isn't a lot more, so it's pretty worth it in my opinion. But yeah, I mean, that's about all for this video. I just want to wanted to go over the portfolio and how it's looking and what stocks I'm investing in, and then also just go over the investment calculator and the power of compound interest and compound growth that can happen if you're consistent for years on end. And just showing you, I mean, those are numbers that I can't even imagine right now, but I'd be very pleased to see one day, and I'm hoping that with consistency that can happen. So yeah, I'm very glad that that's a possibility, and I'm going to keep being consistent and making these videos for you guys, and I appreciate you guys watching. So with that, the video comes to an end. To wrap it up, be sure to smash the like button, subscribe, and also comment down below what stocks you guys want to see me cover. And yeah, I hope to catch you guys in the next one. Peace.